Okay, welcome to rule number 5, which is trading psychology. Now I'm going to rattle through this rule because we've got a lot of rules to go through and not much room. Now typically a private investor, when a share price goes up like this and goes down like this, goes through all these awful emotions. And you know what the funny thing is? You're not alone. Professional investors go through all of this as well. The only difference is professional investors know how to control their emotions. And that is a big difference between private and professional investors. The other key difference is because professional investors know how to control their emotions, they don't do what private investors do, which is buy into a stock at this kind of late stage, all the way up here just before it's about to turn, and hold on too long and sell at this stage. Instead, what a professional does is end up buying here and selling a lot closer to up here. So with trading psychology, and the reason why it's so important, because we manage those emotions, and you need to know a lot more about how to manage those emotions, and professional traders can teach you a lot more about that. One of the key reasons why professional and private investors are so different when it comes to trading psychology, and this came through from when I met 10 of the world's leading traders for a book called The Mind of a Trader, which was published by the Financial Times, is because the trouble with cutting a loss, and the trouble with the loss, is not only loss of money, but loss of ego. Private investors don't know how to love their small losses, so they end up holding and they become big losses. They don't plan ahead. They don't use trading tricks like exiting half their position if they're unsure what to do, whether they should stay in or not. Some of the questions you need to ask when it comes to trading psychology is like this. Why does it feel as if the market's out to get you sometimes? How do you get out of that situation of being controlled by the market to being completely in control of the market? And how do you avoid letting your losses run and instead letting your profits run to be more profitable as a trader? There's a lot more as well, like what are the tricks that professional traders use for trading discipline so that they're not so completely controlled by the markets? And equally, when stocks falls, do you buy more? Or do you not? Which are the right answers? When a stock rises, do you sell or buy? What to do when a stock is rising? Should you double your trade size? Or if it's falling, should you double your trade size? Again, this is where emotion meets trading system meets money management and risk management. And these are all issues which are intertwined, which is why when only we've got all of them right, can we actually start making money or saving money. And that, as I've said, is the key aspect of these CDs.